Hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Today we're going to be discussing variable costing. More specifically, we will be discussing variable costing from a perspective of absorption costing and making decisions based off of variable costing. Before we jump into today's lecture, I do want to touch bases with all of you as to where we are in the course. We are now in week 4. Oh my goodness, week 4. What does that mean? Oh, well, this is an 8-week course for those of you keeping score. We are halfway complete with the course. I know, can you believe it? I can barely believe it myself. What does that mean? Week 4, we have a discussion board for chapter 21. But more importantly, we have the midterm exam. Oh, the midterm. Yes, the midterm. The midterm exam. The midterm exam is currently open and available. The midterm exam must, and I mean must, be completed by April 11th. That's this Sunday. Must be completed by April 11th. There will be no exceptions. 0 exceptions to this policy. You already know that I typically never accept late work, okay? Late work is really unacceptable. It's unacceptable behavior. What does that mean? If you miss the midterm exam, I will not accept it late and I will fail you for the course. Do not miss the midterm exam. It's worth 20% of your entire grade, okay? If you miss this midterm exam, you will fail, and I will not allow you to pass. I'm not trying to be mean. I'm not trying to be hard on you. I'm following the university's policy. The university has a very strict policy. I am required to report midterm grades at the middle of each course. If I report to the university that you're currently failing the course, there's a good chance that there's going to be problems down the road. Okay, I don't want you to fail. Please don't fail this course. How do you not fail this course? You do all the work. If you do all the work in each week, there's a good chance you'll pass. There's a really good chance you'll pass if you do all the work. It's really that simple, honestly. Um, you know, if you do the work, you'll probably pass. I I don't know what to say. I've had a lot of students fail this course, but it's not because they didn't have the opportunity. They failed the course because they didn't do anything. If you don't do the work, you don't pass. It's really that simple. If you're missing work right now, you are in trouble. Okay? If you're missing work right now, you need to get your act together and submit. If you don't, you will fail. You understand that everything in this course, except for the midterm and the final, is worth 5% of your entire grade. If you miss one assignment, it could be one discussion board. If you decide, hey, you know what? I'm not going to do chapter 21 discussion board. That's fine. You just forfeited 5% of your total grade. So if you're okay with dropping half a letter grade by not doing something, that's on you. So my advice to you is do all the work and do it on time. There are 2 things every single week in this course. This is an 8-week course with 15 weeks of content. Okay? So if you decide you don't want to do one of the assignments, you don't want to do the discussion board, you don't want to do stuff on time, you will fail the course. So my advice to you, since we're halfway through this course already, if you're missing something, you're probably going to fail. So do the work and do it on time. If you decide not to take this midterm exam on time, you will fail this course, and I will not allow you to pass. Any questions on that? I'm sorry if I sound upset about it, but I want to get my point across. We good? Okay. All right. So, having said that, what's due this week? You have a discussion board for Chapter 21, and you have a midterm exam. The midterm exam must and will be completed by this Sunday night. No exceptions. The midterm exam, what does it cover? You might be asking. Well, it covers everything weeks 1 through 4. So that, what is that? Chapter 15 through 21 is on the midterm exam. I recommend that you complete Chapter 21 before completing the midterm exam. Review Chapter 21 before completing the midterm exam. The midterm exam covers chapters 15 through 21. It is 20 questions, multiple choice, true, false, matching. 20 questions. 20 questions, 20% of your entire grade is on this exam. It's open book, it's open note, it's not timed. It's open and available right now, even. So just as I've had in my previous courses, I don't time exams. You can save your work and come back to it. So if you're like, oh, you know, Dr. B, I'm going to start the exam today. I'm going to do a little bit of it, and I'll save it, and I'll close it, and then come back to it. And it'll save your responses. Just don't click Save and Submit. Once you click that Submit button, it submits it. Okay? But you can always save your work and then come back. Questions? Is all of that very clear, hopefully?
How many attempts for the midterm? Just only one attempt?
One attempt for the midterm. Yep, that's right. Yeah, with exams, it's only one attempt.
Okay, thank you, Professor.
You're welcome. Good question. Good question. Okay. All right, let's go ahead and get started with chapter 21. This is the only chapter for today, so what does that mean? Nice and easy class. Because you have a lot of work to do.
Professor?
Take the exam. Yes, Drew, please.
Professor?
Yes. Drew, I can hear you. Drew, can you hear us? Drew, go ahead.
Hello?
Yes, Drew.
Yes, I mean, what if I accidentally hit send accidentally?
Yeah, so if that happens accidentally, shoot me an email right away. And
What?
I'll fix it. Okay, good question. I've done that before too, I understand. Okay. All right, very good. Okay, so let's go ahead and jump into today's lecture on variable costing. Variable costing is, you know, direct materials, direct labor, factory overhead. These are all variable costs. These are the costs that make up the total cost of a product. As we go through this chapter,
Hold on. I can't hear you.
that's because I'm not speaking, Drew. Can you please mute yourself unless you have a question? Drew? Drew? Drew, are you having some trouble with the audio? There you go. Thank you. Thank you. You got it. Okay, thank you so much. All right. Sometimes technology, I totally understand. Been there, done that. Okay, let's go ahead and with variable costing. So as you know, variable costing includes direct materials, direct labor, and factory overhead. Drew, you having trouble with your audio?
Yeah, I was having some problems with my audio.
Okay, gotcha. You can hear me now, though, right?
Yeah, I just wanted to know. I just want to know how can I do if I accidentally hit the wrong button and send it accidentally?
Yep. So when that happens, Drew, you send me an email and I will fix it for you.
Okay, thank you.
You're welcome.
Thank you.
Absolutely. Okay. Hold on just a sec. Okay, there we go. Thank you. All right. Variable cost includes direct materials, direct labor, and factory overhead. As you know, those are the costs of manufacturing a product. Those are the total costs. Through this concept of variable costing, there is a key term I'd like you to know. It's called absorption costing. This is where we use generally accepted accounting principles to account for direct materials, direct labor, and factory overhead. Absorption costing, think of a sponge, okay? A sponge. You know, one of the sponges in the kitchen. It absorbs water. A sponge and absorption costing are the same thing. The difference is this absorption costing absorbs all the cost associated with manufacturing. That's why we call it absorption costing. And these costs, as you know, are found on the cost of goods sold, on the income statement, and of course it's also on the balance sheet as inventory. Absorption costing looks like this. The report for absorption costing looks like this. We have sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals operating income. This is the most simplified way of reporting income from operations. As we look at variable costs, we separate them out from our fixed costs. And the reason why we do this is because of decision making. We oftentimes, as managers, need to make decisions to control our costs, our expenses. And to do that, one of the best ways to do that is to separate out our variable from our fixed costs. Variable costs in cost of goods sold, cost of goods manufactured include direct materials, direct labor, and variable factory overhead. So direct materials, direct labor, and variable factory overhead. Variable factory overhead includes costs that are variable within overhead. So an example of variable factory overhead would include utilities. That's variable. It changes month to month. It would include things like maintenance wages, maintenance expenses. These are variable. They change month to month. So when we talk about variable costing, think of the concept of variable. We're not including anything that's fixed. So direct materials, direct labor, and variable factory overhead. Let's compare the two methods. Let's compare absorption costing to variable costing. In absorption costing, we have direct materials, direct labor, variable factory overhead, and fixed factory overhead. That's absorption costing. We absorb all of the costs in manufacturing. In variable costing, we're only interested in direct materials, direct labor, and variable factory overhead. The fixed factory overhead part is expensed out as a period expense. You hopefully remember the term period expense, as within the accounting period we incur expenses. So looking at how a variable cost report is developed, we have sales minus variable cost of goods sold. That would be direct materials, direct labor, variable factory overhead, equals manufacturing margin. Remember the word margin, right? Margin is the difference. Margin is the difference. Minus variable selling and administrative expenses equals contribution margin. Now you all remember contribution margin. That's where we have our sales price minus our variable cost. It gets us the contribution margin. Minus our fixed costs. That'll be fixed manufacturing costs, fixed selling administrative, equals our operating income. And that is the structure of a variable cost for operating income. Manufacturing margin. It's the difference between sales and variable cost of goods sold. Variable cost of goods sold, this is direct materials, direct labor, variable factory overhead. Contribution margin is the difference between our sales price and our variable cost. And then to find our operating income, we take our contribution margin minus our fixed costs. We got operating income. And that's the general structure of it. So let's take a look at an example. You all know I like examples. Examples help us to better understand the concepts. So let's take a look. In this example, we are manufacturing 15,000 units, which are sold at a price of $50 per unit. Oh, that's nice. Oh, I like that. Sell it for $50 a piece. Great idea. Okay, so here's the data we got. Our variable costs, $375,000, about $25 per unit variable cost. Manufacturing costs, $150,000, $10 per unit fixed cost. 10 times 15, 150,000. 25 times 15, 375,000. The total cost of manufacturing a single unit is $35. Okay, so $35 per unit. We sold 15,000 units. That's pretty good. Our total costs for manufacturing are $525,000. We got that by adding our total variable cost and our total fixed cost for manufacturing. Our selling and administrative expenses that are variable are $75,000. We got that by taking $5 per unit of variable selling and administrative expenses times the 15,000 units that we sold. Then we have fixed selling and administrative expenses of $50,000. You'll notice that there is no per unit cost for fixed expenses. That's because since it's fixed, that means it does not change regardless of the level of output. Hopefully you remember that from the earlier chapters. That gives us total selling and administrative expenses, $125,000. Now that we have our data, let's go ahead and plug these into our formulas. So looking at our income statement, We have sales. Remember, the sales price is $50 per unit times 15,000 units sold at 750,000. Our cost of goods sold is $35 per unit times the 15,000 units. How $35 per unit, you might be asking? $25 variable cost manufacturing, $10 fixed cost manufacturing, total of $35. So $35 per unit cost of goods sold, 15,000 units sold, that's $525,000. Sales minus cost of goods sold equals gross profit, $225,000, minus selling and administrative expenses of $125,000. How we got $125,000? $75,000 plus $50,000. Selling administrative expenses. $225,000 gross profit minus selling administrative expenses, $125,000, gets you to an operating income of $100,000. This is absorption costing. Now here's the difference, okay? Because we're going to look at variable costing here in a second. Under the absorption costing model, you see that we have both fixed and variable costs absorbed. Fixed and variable costs absorbed. Okay, $35 cost of goods sold per unit. That includes fixed and variable manufacturing costs. The selling and administrative expenses, we have fixed and variable selling and administrative expenses included. When they're included together, that means it's absorbed. We've absorbed the fixed and variable costs together. Now, let's look at the same exact concept under variable costing. Sales price, still $50. We sold 15,000 units, 750,000. Now, here's where it gets different, okay? We have, and remember, this is variable costing, that's why we separate them out. Variable cost of goods sold, $25 per unit times the 15,000 gets us to $375,000. Sales minus variable cost of goods sold equals manufacturing margin minus our variable selling and administrative expenses. Again, variable, we separated out from fixed. $5 per unit variable selling administrative expenses, sold 15,000 units, it's $75,000. Manufacturing margin minus variable selling administrative expenses equals contribution margin. That's the difference. Remember, we're separating our variable cost from our fixed costs when we talk about variable costing method. And then we have fixed costs. So we have a contribution margin, then you take out your fixed costs. Fixed manufacturing costs $150,000. Fixed selling administrative expenses $50,000. That's a total of $200,000 total fixed costs. Contribution margin $300,000 minus total fixed cost $200,000 equals operating income of $100,000. You see that the operating income is the same under both the absorption costing method and the variable costing method. The reason why we perform both methods is for management to be able to make decisions based on their variable costs. This concept also helps management to understand the impact that variable cost has on inventory. So, here are the facts. If the units manufactured are equal to the units sold, then there's no change in inventory. That makes sense. If the units manufactured are greater than the units sold, that means we had an increase in inventory. That makes sense. I have more on hand. If the units manufactured are less than the number of units sold, there's a decrease in inventory. It also makes sense. I have less on my shelves if I sold more. Those are the effects on inventory. Now let's take a deeper look. So when the units manufactured are the same as units sold, the operating income will be the same under both absorption costing and variable costing. I'll say that again. When the number of units manufactured are the same as the number of units sold, or equal to, the operating income will be the same under both absorption costing and variable costing. When the units manufactured are greater than the number of units sold, the operating income will be less than the absorption costing. Okay, let's take a look at our example. Let's say that we only sold 12,000 units out of the total 15,000 units that we manufactured. In other words, I didn't sell as much as I manufactured. I sold less than what I made. About 3,000 units less, as we can see. What is the impact on the income statement? Well, here's how it looks. Sales, 600,000. I sold 12,000 units. Okay. Variable cost of goods sold. Under variable cost of goods sold, I manufactured 15,000 units, but I only sold 12,000. I still need to account for the 15,000 units that I made. So my variable cost of goods manufactured is 375,000. Variable cost $25 per unit. I made 15,000 units, 375. I have an ending inventory of 3,000 units. How I got 3,000 units ending inventory? I made 15,000 units, but I only sold 12,000. That gives me a difference of 3,000. So 3,000 ending inventory. At a variable cost of $25 per unit, that's 75,000 ending inventory. So how do I figure out my total variable cost of goods sold? I take my total variable cost of goods manufactured minus my ending inventory. Then to find the manufacturing margin, we take our sales minus our total variable cost of goods sold to equal our manufacturing margin. This example, 300,000. Then I need to find my variable selling and administrative expenses. Remember, we only sold 12,000 units, so I'm only going to account for the 12,000 units in selling and administrative expenses. 12,000 units sold times at $5 per unit, variable selling administrative expense is 60,000. So 300,000 minus your 60,000 equals a contribution margin of 240,000. Now, what about fixed costs? As you know, fixed costs do not change regardless of the level of output. Okay, it doesn't matter if I sold 12,000 or 100,000. Fixed costs are fixed costs. Okay, so we have fixed manufacturing costs of 150,000. We have fixed selling administrative expenses, 50,000, giving me a total fixed cost of 200,000. I take my contribution margin minus my total fixed costs equals operating income. In this case, 40,000. Okay. Now, how is that different than absorption costing? Remember, the difference here. Variable costing, we're separating variable costs from fixed costs. In absorption costing, we absorb them together. Okay, so in absorption costing, we sold 600,000, sold 12,000 units, $50 per unit. We have cost of goods manufactured of 525,000. How is that? Remember, variable and fixed together. $35 per unit. We made 15,000 units. We have an ending inventory of 3,000 units at $35 per unit. Cost of goods manufactured minus your ending inventory equals your cost of goods sold. Sales minus cost of goods sold equals gross profit minus selling and administrative expenses. Again, absorption costing, we have both variable and fixed together. Gross profit minus selling and administrative expenses equals an operating income of 70,000. We see that under absorption costing, we have a higher operating income. Under variable costing, we have a lower operating income. Which of the two is most accurate? Of course, it'll be variable costing. So with this difference, what does the difference do? What does it mean? It's a difference of 30,000. Under the absorption costing model, we had 70,000. Under the variable costing model, we had 40,000 operating income. That's a difference of 30. So what does the difference mean? Well, it means that we, because of the difference between the two models, we recognize that because we, in one model, we separate out the variable cost from the fixed cost, and the other model, we have them together, we have a lower operating income using the variable model because we recognize that that management can control the variable expense, the variable cost. And that's the reason why the two are so substantially different. Okay, so what happens when the opposite occurs? Meaning we manufactured less than the number of the units that we sold. That happens from time to time, right? So we have an example. Beginning inventory, 5,000 units. Units manufactured during the period, 10,000. We sold during the period 15,000 units. Okay, here we go. Beginning inventory, we started with 5,000 units. We have variable manufacturing costs, $25 per unit. Fixed, $10 per unit. Total manufacturing cost, $35 per unit. We take the beginning inventory amount, 5,000 units, times respective unit costs. 5,000 times 25 is 125. 5,000 times 10, 50. $35 per unit is 175,000 total cost. Okay. We made, during the current period, 10,000 units. All right. Here's a difference, okay? We have variable manufacturing costs made 10,000 units, $25 per unit. It's $250. Here's where the difference comes into play. We have $15 per unit of fixed cost instead of 10 during the accounting period. Why did that happen, you might be asking? Why? What caused the change in $5? Well, what happened is our fixed costs increased during that accounting period. What caused it to increase? I don't know. It could have been an increase in salaries, supervisor salaries. It could have been an increase in rent. It could have been an increase in something along those lines, depreciation expense maybe. And so it increased the unit fixed cost by $5. So fixed cost per unit times 10,000, 150. Our total manufacturing cost per unit during the accounting period is $40 per unit. Then of course we have our selling administrative expenses, $5 per unit, 15,000 units sold, 75. Then we have fixed, 50,000. Total selling administrative expenses, 125. How does it look? How does it compare? Okay, sales, 750,000. $50 selling price times 15,000 units sold. Beginning inventory, 175,000 on our absorption costing. $35 per unit of cost of goods sold, cost of goods manufactured. Why 35? Because that includes 25 variable plus $10 fixed. That's how you get 35. Times 5,000 units at the beginning inventory, that's 175. During the accounting period, we manufactured 10,000 units at a cost of $40 per unit. We had variable cost $25 per unit plus a $15 per unit fixed. So that's $40 per unit. 10,000 times 40 is 400. Total cost of goods sold is 575. Sales minus total cost of goods sold equals gross profit 175 minus selling administrative expenses of 125. Remember that's variable plus fixed. Equals an operating income of 50,000. That's gross profit minus selling administrative expenses. Remember, anytime you see the number in brackets, it means it's negative or minus. We subtract. We're subtracting. On the right side, on the right column. Under variable costing model, sales 750,000. Our variable cost of goods sold, beginning inventory $25 per unit variable cost times 5,000 units is 125,000. Variable cost of goods manufactured during the accounting period, still $25 per unit, 10,000 units that we made during the period, that's 250,000. Total variable cost of goods sold, 375. 750 minus 375 is 375 manufacturing margin. Variable selling administrative expenses, $5 per unit, 15,000 units sold during the period. That's 75,000. So 375 minus your 75 gets you to 300,000 contribution margin minus your fixed costs. Fixed manufacturing costs 150. Fixed selling administrative expenses 50. That's 200. 300 minus 200 is 100. We can see that there is a $50,000 difference between absorption costing and variable costing. We can also see in this case that variable costing is higher by that 50,000. What causes this difference? Well, the beginning inventory had a lower fixed cost because it was made during a different time, and our fixed cost went up by $5. So that's one of the reasons. And of course, under the absorption costing model, we include the fixed costs within cost of goods sold. So of course, that will also lead to a lower margin. And under absorption costing, we the 50,000 was included as an expense during the accounting period. So, if the units manufactured are the same as units sold, the absorption costing model and the variable costing model operating incomes will be the same. We're just recapping now, right? If units manufactured are greater than units sold, then absorption costing will be greater than variable costing. If the units manufactured are less than the number of units sold, then absorption costing will be less than variable costing. It's kind of like a cheat sheet, right? All right. Any questions so far? We're doing okay? Drew, are we doing okay?
Professor.
Excellent. Thank you. Thank you. Drew, we doing okay, buddy? All's good? All right. All right. Very good. Okay. I got to check on you guys. I know how boring sometimes this stuff gets, so. All right. Let's take a look. As we analyze the income under absorption and variable costing, primarily we're looking at the difference in our inventory. And as managers, we can make decisions about our costing models based off of the impact it's having on our inventory. Let's take a look at another example. So let's say our company does not have any beginning inventory, and we sold, or we're expected to sell 20,000 units at $75 per unit sales price. And we say that we're not going to make any more than 20,000 units. We're only going to make the 20,000 units, and we're going to sell all 20,000 units at $75 per unit. And there's a proposal, okay? The proposal here is instead of just making the 20,000 units, what happens if we make 25,000 units? What's going to be the difference on the cost? So in management, oftentimes we're faced with decisions, especially in manufacturing, to increase or decrease our manufacturing capacity. And so in that decision making, we need to run out the models. And we say, okay, well, proposal one is let's just manufacture the 20,000. Proposal two is let's manufacture 25. So what do? Well, let's run it out. First, we figure out our variable and fixed manufacturing costs. We have variable manufacturing cost $35 per unit, fixed cost $20 per unit. How did we find the $20 per unit of fixed cost? You might be asking. Well, we have total fixed manufacturing costs of 400,000. We're going to make 20,000 units. So it's just a matter of taking your total cost divided by the number of units we plan to manufacture. And that's how you can find your unit cost. Selling administrative expenses, we have variable and fixed, $5 per unit variable. Selling administrative expenses, $100,000 fixed. So we got the information for proposal one. Now let's look at proposal two. Okay, proposal 2, let's make 25,000 units. All right, but we're only going to sell 20,000. Proposal 2, it's kind of like saying, you know what, I want to make a little bit more inventory just in case I end up selling more, or I want that buffer, or I want a beginning inventory for the next accounting period. That's the reason why people do it. So to find variable costs, we got 875,000. It's 25,000 units times the $35 variable cost. Now we notice that our fixed costs are higher under this proposal. We have $16 per unit fixed cost. How did we get that? We took our total fixed cost for manufacturing 400,000 divided by the total number of units we plan to manufacture, 25,000. So 400,000 divided by 25,000 gets us a total manufacturing cost, 1,225,000. That's variable plus your fixed. That's $51 per unit is the cost. And we have selling administrative expenses, variable $5 per unit, gives us 100,000. How 100,000? Well, remember, we're going to manufacture 25,000 units, but we're only going to sell 20,000. So 5 times 20 is 100. Then we have fixed cost 100, so total selling administrative 200. Now, let's put the two proposals side by side on our income statement. And we'll do it first for absorption costing. Under absorption costing, we can see that proposal 2 is the better option. How is that? Why would I say that, right? We'll take a look at your sales. We're only going to sell 20,000 units at $75 per unit. So both proposals are the same, 1.5 million in sales. Here's where they start to get different. Cost of goods manufactured, $55 per unit under proposal 1, 20,000 units. Under proposal 2, we're going to make 25,000 units at $51 a unit. Okay. Then under proposal 2, I'm going to have ending inventory. Because remember, I'm only selling 20,000 units, but I'm making 25. So 5,000 units ending inventory at $51 per unit is $255,000. So we take our we take our cost of goods manufactured minus our ending inventory, get total cost of goods sold. We can see at this point where total cost of goods sold is, under proposal 2, it's less than proposal 1. Well, that's interesting. And the reason for that is because of the ending inventory. Because, you know, I didn't sell that, either way, I still only sold 20,000 units. But we can also see that total cost of goods sold is slightly lower under proposal 2. So cost of goods sales minus cost of goods sold equals gross profit. Gross profit is higher under proposal 2 by 80,000. Gross profit minus selling administrative expenses. Selling administrative expenses are the same under proposal 1 and proposal 2, because remember, under absorption costing, we have both variable and fixed costs together. Operating income. Proposal 1 is 200,000, proposal 2 is 280. So far, based on absorption costing, proposal 2 is the best option. On the surface, it looks like a good decision. Oh, okay, let's go with proposal 2. We'll increase our operating income by 80,000. We'll increase our, profit ultimately by simply producing another 5,000 units. Sounds great. Okay, so proposal 2, management might say, great idea. It's awesome idea. We're going to make some more profit. Cost of goods sold be a little bit less. Sounds great. Awesome. Okay. Under variable costing, the operating income is 200,000 regardless of whether we made 20 or 25,000 units. And that's because there are no fixed manufacturing costs included. Because remember, variable costing, we separate out the variable cost from the fixed cost. Under absorption costing, we include the two together. And so, from that perspective, I think it's an interesting concept. Now, let's take a look at the variable costing model. If we made 20,000 units, 25,000 units, 30,000 units, doesn't matter. We only sold 20,000 units, so the sales is the same. Take a look at the difference. Variable cost of goods manufactured, $35 per unit, regardless of how many you made. Ending inventory, still $35 per unit, regardless of how many you made. Okay, so therefore, your variable cost of goods sold is the same. Your manufacturing margin, the same. Variable selling and administrative expenses, the same. Contribution margin, doesn't make a difference. It doesn't matter if I made 20,000, 25,000, 30,000. The only difference is going to be under the variable cost. And because of that, everything else is the same. So the operating income is going to be 200,000 regardless of how much we made, how much we manufactured. Interesting, right? When do we use them? When do we use absorption costing and variable costing? Management uses these models to control costs, definitely. To price products. When we do product pricing, we consider our total costs. We want to make sure that when we sell a product, we're covering our total costs. Because otherwise, we might sell it at a loss. We don't want to do that. So these models help us to understand what our total costs are, variable and fixed. They help us to plan for future production, and of course, help us to analyze market segments. And as we go through the process, we make our reports, absorption costing reports, variable costing reports. They help management to make decisions, to control costs, price our products appropriately, plan for production, and analyze market segments. As we can control costs, we're looking at costs that are within our control. A lot of times, these are our variable costs. That's why the variable costing model is very, very helpful for management to control our costs, because variable costs are really the only costs that management has the ability to control. Non-controllable costs are things without control, and that would be things like the rent, salaries, other things, other fixed costs that are not in our control. So variable costs we have the most ability to control variable costs, and that's why these reports are very helpful. As we price products, these reports help us to identify our total costs, and we need to make sure that we price products above the total cost in order to generate a profit. So the variable cost model helps us to separate variable from fixed costs, and it helps us to identify the price point that we need to provide in order to cover all of those costs. So in the long run, we typically try to sell a product above our variable and fixed costs to generate an income. That makes sense. I mean, the whole idea of being in business is to generate profit, right? Generate income. And these reports help us to plan for production based off of capacity. Some businesses have swings in capacity depending on seasons, depending on customer tastes. You know, it's very typical in business. By using something like variable costing, it can help us to identify those types of trends. And the last one is to understand the market segments. Market segments are a portion of the company based off of sales, costs, expenses to determine profitability. Market segments are things like sales territories, products, salespeople, customers. We call those segments. Hopefully you learned that way back when in Introduction to Business. For those of you who are in marketing, you'll learn more about that in marketing. But the idea behind it is that as the company continues to sell products, we can analyze the sales data, and we do that through market segments. We look at absorption costing and its long-term effects on the market. We look at variable costing and short-term effects on the market. We typically prepare variable costing to help us to understand our market segments and how to understand trends and changes in trends for geographical areas, customers, distribution channels, and salespeople. Let's take a look at this through an example. We have a company that manufactures cologne and perfume. Okay, and this company that manufactures cologne and perfume is separated into two territories, the North and the South. And we can see the sales data for both the perfume and the cologne in both regions. Based off of the sales data, management can make decisions on shifting in the trends. We have sales, we have variable production costs for both, of course, which the company has determined to be 12% of their sales, is found in the variable cost. Then, of course, we have other costs that are variable, such as your selling costs. Selling costs, as you know, include both promotion, which is advertising, and things like sales commissions. Those are all selling costs. And we can see that the company has estimated those to be a percentage of sales. And then we can analyze all that data to understand how to reduce costs in lower profit territories and increase sales in higher profit territories. And what that does is ultimately, it should hopefully result in higher profits for the company. And these are the types of reports that we would look at to understand that type of information. This one's called the contribution margin by sales territory. Basically, it's the same as we've seen before, a contribution margin report. And what this does is it helps us to understand it by territory, or also known as by segment. The contribution margin. Contribution margin, as you know, is the sales price minus the variable cost. Contribution margin ratio, as you know, is the contribution margin divided by sales. Contribution margin, sales price minus variable cost divided by sales. That's your contribution margin ratio. In business, we have these things called a sales mix. This refers to the different types of products that we sell relative to the territories. We can calculate the percentage of sales mix for each territory by dividing sales of each product divided by the total sales in each territory. And what that does is it provides us with this thing called a territory sales mix. Basically, what that does is it tells us how much of a product we are selling in each region. It's kind of cool. It's interesting sales data. And as managers, that helps us to identify trends, identify weaknesses in the company, and helps us to overall improve our margins. Margin meaning profit, of course. So the company's focus on maximizing contribution margin, profit, and to produce profitability, and that helps us to make decisions on sales and promotions. This is an example of the contribution margin report by product. We got our two products. We have our sales minus variable costs equals manufacturing margin minus variable expenses equals contribution margin. And of course, contribution margin ratio is found by taking contribution margin divided by sales. And based off of the trends that we see on those types of reports, we can consider things like marketing plans, promotions, which means advertising, sales commissions, costs, and pricing. And all of these things together help us to identify profitability. We can look at profitability down to the detail level of each salesperson even. And we do this through this thing called a salesperson profitability report. And what that does is it shows us each individual salesperson's sales and their contribution margins. This tells me how well a salesperson is performing. Which is kind of, it's interesting to look at because it helps managers to identify who their best salespeople are. And it also helps them to control sales commissions. It's kind of cool. And as we evaluate a salesperson's performance, we look at their sales growth from year to year, their level of experience, customer service, sales territory size, and actual performance compared to the budget. And this type of information is very, very useful even in the service business. I know that some of you are hospitality majors, and you can actually use these types of reports in your hospitality business, your service business. You could use variable costing report to help you to identify your variable and fixed costs. That will help you to better manage them. So in an example, if we have an airline, which is a service business, as you know, we have variable and fixed costs. Depreciation expense, it's fixed. Rental expenses, that's fixed. Then we have variable costs like food and beverage, fuel expenses, selling expenses, wages expenses. They're all variable because they're based on the level of output or the number of flights. And since we can classify fixed and variable costs, we can perform a variable cost report that tells us information on the performance of the airline. And what that looks like is here we have revenue minus our variable costs equals contribution margin minus our fixed costs equals operating income. and we can see the information broken out and how that information impacts our business. That's pretty self-serve. What do managers do? We look at these types of reports. We analyze, evaluate the information that helps us to identify our market segments. And you can do this really with pretty much any company. This type of reporting is useful for any company. And this just kind of gives you an idea of what market segments belong to which kind of service industries. So we can see hotels. The market segments are hotel properties. Typically, these are found within regions. So, for example, for those of you in the hotel business or in the hospitality business, you could look at your market segments, which are based off of the region that you're in, and compare your property to other properties in the area. Just fun, interesting stuff, right? In this example, we're looking at comparison for an airline, but you can do the same thing for a hotel. We see, based off of the market segments, the average ticket prices, passengers served, miles flown, and we see all the variable costs included. And we can break it out by market segment. It's really the same concept. It's just fun. It's fun to do. It's interesting. It helps management to understand their business. I want to talk about this last concept for today. It's called the EBITDA. Have you heard of the term EBITDA before? Earnings before interest, taxes, so forth, so on. No? Yes, maybe. So, this is an interesting concept because it helps businesses to understand their overall performance. EBITDA is earnings before interest, taxes, depreciation, and amortization. That's what EBITDA stands for. And you'll see this commonly on an income statement toward the very bottom of the income statement for publicly traded companies. And this information tells us it's kind of like their gross profit, yeah. And it tells us the amount that the company is controlling in certain segments. And in this example, we're just looking at it through Amazon Web Services. And it kind of this information tells us the percentage of the market that the company controls. Interesting data. Interesting data. So the earnings before interest, earnings before interest, taxes, depreciation, and amortization is found in the income statement toward the bottom, and it really tells us the contribution margin for the company as a segment. And it's helpful to know. It's not critical to know, but it's helpful to know, especially as the company is looking at their different segments and they're looking to grow the company based off of this information. And that, my friends, is the conclusion of variable costing. Are there any comments, questions, concerns, anything at all that I can help you with? Was it helpful, hopefully? You're all still there, right? I haven't put you all to sleep. I know this is super boring. You're good? Really?
Yeah, it's good. Sounds good.
Awesome. Very good. Great. Only half asleep. Same here, Dylan. It's still early. Okay. If you think of anything, if you need help along the way, feel free to call me, email me, set up office hours, all of those good things. A reminder. So what's going on this week? And please make sure that you do it on time. Chapter 21 discussion board. Full paragraphs, please. Full paragraphs. Full paragraph responses. Full paragraph posts. Please, full paragraphs. No, there's no good job. That's nice. No, please don't make those kind of responses. That's not good. Okay. So discussion boards due Sunday night. And the midterm exam is also due by Sunday night, no exceptions. Please do not be late. That will not be good. Okay. Okay, have at it. The midterm exam is open and available. Start it now. Take your time with it. Save it. Return to it later. If you click submit, it'll submit it. Okay, so if you do that accidentally, just reach out to me. Send me a quick email and I'll fix it for you. But please don't do that. Okay, only submit when you're ready. Any questions? We're okay? All right. In that case, thank you all so very much for your time today. I appreciate all of you. If you have any questions along the way, shoot me an email. I'll be there for you. And I'm looking forward to your wonderful submissions. So thank you again so much. And you know what I'm about to say, right? Stay safe. Wash your hands. Do the right things. And I'll see you again next time. Thank you all so much. Have a great rest of your day.
Thank you.
Thank you, Professor. Have a nice day.
Thank you. You as well. Always a pleasure.
Professor, I gotta talk to you.
Okay, sounds good. Let me stop the recording and you and I can talk, okay?
All right.
All right.